The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi, everyone, on the 16th, on this 16th day of January. Oh, my nephew's birthday, and I completely forgot to send it. It's already the 17th over there. Oh, all right. Well, that's the way it goes. So this is the 16th of Friday, the 16th of January. Remember, it was back in 1990, was it? This was when we went to war, and there was the greatest, most humongous upside spike, a huge gap in the market as the market exploded higher. All right, so we are looking. Thank you to John. You got Steve. You got Tom. You got Daryl for great hours before this show, and we'll try to continue that aspect of technical analysis right into the 6 o'clock show this evening. So we had the Dow down sharply, and then a sudden turnaround. Let me give you the numbers so we can go to a whole bunch of technical. This is Technical Friday, where we look at some of the Chapman wave techniques in a little bit greater detail. The Dow is up 67 at 17,388. The S&P is up 11 at 2,004. The comp index is up 25 at 45.96. Gold is up 8 at 12.72. Silver is up 44 at 17.54. Platinum is up 5 at 12.65. High-grade copper, finally, you got to move in high-grade copper. It's at 259, up 3.7. Even crude oil is up $1.64 at 47.88. You got bonds down 21.30 seconds. Oh, bonds are down. Oh, let me just rub my eyes and check that out. Yes, the TLC is down 155 at 133 and 30 seconds. This is going to be a really, really interesting day. Why? Because the dollar is at 93.31, up 0.70, and the euro is down. It's at 1.150. This is going to be a fascinating session for a couple of reasons. First, I just want to quickly show the technique of the Chapman wave methodology. If you are looking at this chart right here, this is a 10-minute chart of the March S&P mini E-mini. Went from the lowest, most identifiable low bar right there at 4:50, 10 to 5 this morning Eastern time at 1973.25. Then it went to, and the objective is to identify the lowest, most obvious low bar. This is kind of the easy way to do it. And what we did is we went at that bar, it went peak A, B, C, pulls back quite deeply. Then it has a double top, then a cup formation, and whoosh, it breaks out. I never like cup and handles because they invariably come back and retest the left side lip and go quite a bit under it into the handle. That's exactly what happened here from that peak D at 1994.50. It dropped sharply down to 1981.25. And now it's gone another leg up and another leg. That is a power because I don't have the technicals here, and the chart is so strong. I've called it leg E/A, F/B. If it only pulls back to 1996, 97, and then breaks to a new high, that'll confirm for me that's a new leg C to the upside. In the Chapman wave methodology, what you do is at D is where you want to take some profits because that's where you can have. That's where you can have the sharpest, most identifiable pullback. Wait a minute. I don't have any technicals whatsoever. I do have candles. I didn't have to. I just want to make it nice and broad. Why? Because I'm only looking at highs and lows of the entire bar. So you see that candle there? Doji candle, that could in fact just be a bar candle, and that's all I needed. That high was a turnaround. So what we're looking at here is some kind of a pullback. In this methodology, you take something off and you can keep the rest, but you better make sure that you got a fairly tight stop. And that's the way it's looking here. Well, wait a minute. Here I've got my technicals. Got the 200 period exponential moving average. You've got the 9 period exponential moving average, the maroon line there. You've got the MACD, the moving average convergence, divergence. You've got many others. You've got the slow stochastic, you've got on-balance volume. And this is suggesting with that doji candle there, that probably I need to be a little bit prudent. If I was long, I would have taken some profit there. In fact, It, because whenever I do the show, it's always best for me to clear my head. That's where you don't want any you don't want to be doing two things at once. Okay, so this is where always when if I'm trading, I kind of clear my head and just get right out as my show is beginning because I do not want to be looking at two things at once. However, the stochastics at 83%, so far that's still good, and that MACD fast moving average is still very good. So if I was using chart formations right here, I would say that a close underneath this high of 1995 on this 10-minute bar would be a negative, and that if we were to bounce now towards the 1997 area, it's at 1996, that would say, hey, probably a high-level consolidation based on the techniques here. And where would I enter? Well, I would try to enter. I would just have patience at this particular point. I have to wait for a test of 1993 to 1992.56. If I'm using a 10-minute chart, then this is the 9-period exponential moving average. All right, let's get this out the way. Why? Because I just wanted to show you the basic concept so I can discuss many other things of identifying the lowest low bar, expecting a leg D, and why it was a little bit of a mystery here for me in certain circumstances. Also, I did a couple of emails here. I just wanted to mention, when I put on the trades for my subscribers, because some people have the ability to get in to a position prior to the market opening because they can trade in hours that are not regular market hours. Sometimes you get a discrepancy of what's going on. For instance, we had a fantastic trade the other day in the natural gas. And because we were able to get it in those few moments that it just gave us the price pre-market, just as I sent out my newsletter at 8:35, at 8:37, 8:30, 8:39, there was this pullback and it managed to give it, and it spiked up very sharply for very nice intraday gain. We got out, we got stopped out on one half a position and then the other half. So I wanted to put the half position that had a 20-cent, only a 20-cent gain, put it back on this morning. And the irony is, if you got it this morning, pre-market, you were stopped out, just barely stopped out, but stopped out nevertheless. So a fairly small gain considering what we had. But if you got it at 9:30, like many people do, then you're looking good because it's gone to 1605, the particular instrument that we have, which is 40 cents higher than where we entered it. Days younger could still give it all back, but it's just an irony. Now I have to have two positions in my trader's corner. One for those that, unfortunately, I mean, I don't know what to do. I don't know how you deal with this stuff, because when we get stopped out pre-market, I have to take it because the price hit it. If the price hits, the price hits. I can't, you know, that's just the way it is. So, so this is the situation. But it is in natural gas, as I'm looking at it, I think just a bottom, not the bottom, just a bottom, I think has been established. And as such, what we're looking at is this is leg A, and it gave back quite a bit, but this still looks like not an A failure yet, but it's a leg A in natural gas. And if at any point it goes over 3.352, even by 1.001, that's going to be fantastic, because that'll say either A is extended or you've got leg B if it's on Monday. And the stop's just real clear. I mean, this is, you know, this is a 120-minute chart. It looks pretty good right now. It made a peak E at that top yesterday. So all of this is kind of formulating in a way that is making a little bit of sense at this particular time. Now, if I am looking at on a purely technical basis, you know what? It's going to be so much easier if I use our next caller to go through all the things that I'm looking at instead of doing it twice or in different ways. I'm going to go to Ben in Tallahassee. Ben, how are you?
Very good, Basil. How are you?
Okay. Now, I think the big question you're going to ask me is, are we still going to go to all-time highs? Is that the question, Ben?
Well, I guess you could put that in with what's your latest analysis. Really, the million-dollar question for me is, what would change your assessment of the weekly Dow wave count?
Okay, so let's go to that, because the only reason why I got a little befuddled over here with this latest thing, because normally I would have looked at this and said, hey, single leg A up in the Dow, is that going to be a single leg A failure pattern? and I would have grabbed it from that doji sign and doji candle. But my thinking has been that the weekly chart has only made a peak C. So now let's do this. Let me just quickly tell you my thinking. My overall thinking is that we have still got to make wave 4 to the downside in Elliott wave, and then 5 to the upside. That's my bigger picture, and I'm only using that because it makes it a little bit clearer, and it makes it understandable for many people that this is a peak E that's being made in January if there's no new high above 18,103 in the monthly chart. But because of the pattern that I'm looking at, there is even a chance that it could have recycled to E/A. I don't know yet. I don't have to think about it as of now because January hasn't completed. I just wanted to put that out there that this is still, I believe I have to still call it wave 3 in Elliott wave, and very powerful leg E. At the moment, I'm calling it E in the monthly chart. So now let's go back to our story. When I'm looking at the news that's gone, the news that's filtered through the market over the past, since the end of December. And you put that into a log and you said, hey, just read this and tell me where you think the Dow would be. But please include that the volatility index, and to me, it's just absolutely one of the major ingredients of what I look at, the VIX index. Please consider that the VIX index is gone. Even now, with the Dow up 61 and the S&P up 11, the VIX is at 22.46, having gone to leg C in an inside buy mode. Whoops, not a B, but a C. A leg C. How could that be? Look at the weekly chart. If we close here on a weekly basis, I have to consider that VIX is so important that having rallied to this particular level, I cannot ignore it, and I cannot say that my Chapman wave methodology is bulletproof, that no matter what, we should make a D in the weekly chart. So I'm just throwing that out. Now let me go through all the different conditions that we're looking at. And if you ask me if I read the list, including yesterday's discounting in Switzerland, as essentially taking a fixed price and in a split second saying, oops, by the way, the fixed price is not at $1, it is at, and then you name your price. Let's say it's 70 or 60 cents, and just say, oh, by the way, that's the new price. Excuse me, that's the new price. That is an amazing feat for the market to have survived so far, to still be above the 70. And let me just show you right now why I'm thinking this and what I'm thinking, because I want to give you, as if you don't mind, are you able to hold, Ben?
Oh yeah, no problem.
Great. Because to be able to say that 17,262 low of the 6th of January held is an amazing feat. So we'll be back and we'll talk about, put this all together. I'll be right back with Ben.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Basil takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back, and we're on with Ben in Tallahassee, and we're looking at the Dow. I'm just showing the Dow chart. What I thought was really important support was the 17,262 low that was hit on the 6th of January. Huge bounce, almost taking it to nearly 200 points from an all-time high. It went to 17,916, then 17,923, all-time high is 18,103. Instead, it just turns around, reverses, and it gives you the H pattern. The H pattern has the chance of making a cup formation. It had a chance. Now it's getting a little more difficult, but that 17,264 Roman candle low that I said, if the Dow trades for more than 2 bars, 220-minute bars, underneath 17,350, there's a good chance you're going to test and maybe even break that low of 17,264. We did that today, but we did it only momentarily. We went to 17,243, 20 points lower. Now we're bouncing above. So if you said to me with a list of all the things that have been negative, that the Dow has not gone to the 16,900s, hey, the day is young, could still do that, but it hadn't yet, I would have said that is demonstrating enough internal support, as well as the chart pattern that I show my subscribers of the Dow 120-minute chart. What I spoke about is this oval pattern between the Dow 120 and the VIX 120, making a cup formation, and that at some point really soon we should see whether or not we're going to break lower into the 17,100, 17,000 area, with the VIX skyrocketing above 25 into the 26s actually, or whether we're going to find some kind of support here. So to go with that, let's go back to the weekly chart, because today at 4 o'clock, you've got the close of the week. There is absolutely no chance whatsoever today of us breaking above the 9-period exponential moving average.
Since you're going to the weeklies, I just want to triple check here. Do you see the weekly VIX in peak C?
It is just about. Let me just double check. Maybe by now it's done that. This is in. There's a peak C on October the 14th at 3106. This is like an inside buy that's gone to a peak A. This is a secondary peak A. I call it the gray A. Let me just change the color. Gray A at 25.20 on the 19th, the week of the 19th of December, pulls back to the 14th, and now it's at 22.62. If it breaks above 25.21, that'll be gray B. There's even the possibility, see, I'm talking about January being a really, really whippy month. I don't know if there's a possibility now of us making that or just a fractional new high above 18,103 in the Dow to make that leg deep. But if the volatility index just keeps creeping up with higher highs and higher lows without a spectacular thrust into the 30s, we could get what I call the inside bar. And then comes February, or something like that, February, maybe even March. And then you get this major VIX index spiral to the upside and a major market low, and that starts leg 5 up, wave 5 in the Elliott wave, and that coincides with me having to look at the monthly charts to see whether we're recycled, what the letter is. So it's a very complex picture that can be made real simple by saying enough categories. Now you've got auto parts, you've got the autos, which should be doing fantastic. I went to the show yesterday here in the New England area, down in Boston at the Boston International Center, and that I don't want to waste time now talking about it. I'll talk about it over the next week. Other than to say, if anybody has a chance, whether you're looking for a new car or not, you want to see just the variety of cars, and the American cars, the quality has improved. The Lincoln it's outstripped everything I thought it would have done. I haven't driven any of them, so I can't talk about that. But that says to me that American automobile companies should do well this year. But the prices are not doing all that great right now. So now let's go back to so the answer is it's only in an A, and it's in another A right now, which will become a B, what I call a gray B, at 25.21 on the VIX. Now let's go back to the Dow. And in the Dow, oops, I just did that.
So real quick, so you don't consider that 10/13 date of the VIX a weekly peak C?
Yeah, that the October is a peak C. But when you get peaks underneath it,
I don't think it went underneath it, did it?
No. Let me go back again. We must be absolutely clear here. The VIX is in peak C. It didn't abort because it didn't go underneath the starting point of 10.28. So it's still active. Now it's a sentiment indicator, and these things, like in the monthly, almost always fail only at a B or even an A. Occasionally they'll go to a D. So we've got a break coming up, and then I'm going to I want to do the weekly chart to show you exactly what I'm looking at and how it's possible for it to pan out. So can you hold?
Okay, Basil, thank you very much. I'll listen up.
Okay, good.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. So the Dow's up 40, but right now I'm going to do this because I do want to go to Garo in California. I want you to also just quickly say we've got a caller on the line after Garo who wants to talk about the S&P. So I'll continue this discussion about the weekly charts of the S&P and the Dow in a short while. First, I'm going to go to Garo because he's been waiting a while. Garo, how are you?
How are you?
I'm well, thank you.
Very good, very good. I'm calling regarding the Apple. Still, I'm in short. I shorted at 111 when it crossed the 200-day line down at 60 minutes.
Right.
If you don't use SAR parabolic dots, but it is coming very close to SAR parabolic dots at the bottom, which is $105.46. If that crosses that point, $105.46, I'm going to short more.
Okay.
So what is your idea, sir?
So let me just give me 1 second here. I'm going to put this in 120-minute chart. Let me see if I can find this one here. Okay, I believe this is the way. I've got this ready, all ready for you. So the SAR on the 120-minute chart, just like I have on my 200-period exponential moving average, it went right to the ups. Wrong chart. It's just showing it in natural gas, which showed how it pulled back quickly. But I remember seeing this in the. I did this earlier. I did it yesterday, and I remember seeing that this is the chart that has the SAR, especially because you use it, and that is the SAR. It's a parabolic. It's one of the technical terms tools. And what happened is it touched right there. On the 11th, it went to 112.80. And as it pulled back from that level, that's where it gave you a negative a technical indicator. So yes, what I'm looking at here, I'm going to say I like you that you've traded this absolutely fantastically, Garo, because Apple is not participating whatsoever, even though it's options expiration. It's at 106.05. It's down 77 cents. But the same pattern that I've been looking at is called the dreaded H. I'm not going to show it now in my CD introducing the Chapman Wave methodology. But this H pattern that we spoke about is kicking in right now and says Apple wants to test 104.63. And there's a good chance that if it was to break that, you could draw a trend line, a declining trend line, just a real simple declining trend line, and say Apple would have a projection of the 103s if it was to close. I would even say that if it closed under 105 between today and Monday, there's a good chance it's going to quickly snap through 104.63 and go to the 103s. So I think you've got you got a beautiful trade here. The 120-minute chart shows there's a little bit of an attempt to bounce, but the fact that it hasn't been able to bounce thus far says that trough A, B, C, D. Yep, it should. This is the bar. This is the 104s. That bar of 130 on the 6th of January that has a high of 106.38 and a low of 104.63. That's the candle that it's trying to head for. Hey, nice trade. Wow, you really use that technique so well.
Okay, thank you, sir. Thanks so much. I appreciate it. I'll talk to you Monday. Thank you.
Thank you very much. And I would just say on a little bit of a portion of your position, just watch 107.45. That's the resistance in the 9-period moving average. Hey, nice move. Thank you for calling, Garo. Let's go on to Marvin in Orlando. Marvin, how are you?
Hi, thanks for taking my call.
My pleasure.
I was looking at your monthly chart, and I was wondering, if one scenario is a correction that could last into March and April timeframe, then on the monthly chart, that means the E will not go to an F, right? Is that a scenario that you're considering?
Okay, so let's just go through this so folks know exactly what we're talking about. Folks, we're talking about a monthly chart that using just a simple technique, the 9-period exponential moving average, just fractionally once in, that was 2012. Yep, in May of 2012, it just snuck one little tiny fraction under the 9-period moving average. But once it hit that 9-period moving average and the bounce from October of 2011 and then the breakout of January 2012, it has only once in the past 2 years broken the 9 EMA, and that was October, and then it spiraled right back above it. So now, for the first time, you've got a candle within 4 monthly periods. You've got a candle that broke under it, spiked above it, tested it in December by touching 1972.56, trying to rally in January, and then retesting it as of the last week, testing the, let me just give you the exact number, 1983 is the level to watch in the 9-period moving average of the S&P. Now, I'm going to do this. I haven't done this for a long time. I'm going to show something because the first time that it's actually happening. In the S&P monthly chart, the MACD right now, and of course, this is exactly halfway through the month. The MACD is 142.16 and 142.04. In other words, right as we are speaking, you've got the very first time that they are touching. The fast-moving average and the slow-moving average are actually touching. So that's just a sign. It's a hint. It's a way of looking at it and saying, hey, got to be careful over here. Something's happening. Now the MACD, the stochastic, the slow stochastic, is 88.48 and 93.35. 93 is just fantastic. For a price to be holding at that level, it says that is tremendous support. It is the middle of the month, but at this particular point, the technical indicators are saying that the 1983 level of the 9-period exponential moving average, if we close January That is, you have to wait for the very last trading hour of the month. If closed January under 1983, for the first time, we've got a signal. It's not a sell signal in the monthly chart, but it's the first warning that we've had in ever so long that there could be a deeper decline. So now comes the big question. How do I resolve? So the answer to you is I still will call it E unless the S&P breaks under 1900 between now and February. If it does that, and that's 1,000 points in the Dow, if it breaks under that level, I'm going to have to say, oh, if that's an E, we could be in for an even longer decline in time. But I'm just going to go one step at a time. And if you don't mind, I'm just going to show you here in Tiger TV. This is the chart. I'm opening it up. This is the chart right here. Normally it's in the middle. I'm just expanding it to show how important this weekly chart, which has made a peak B. And, unless in this particular instance, I could possibly use something that I call the unconventional flat base restart and call this a leg EF, a peak F. It's just starting to make things a little bit fuzzy if I do that, and it's only trying to satisfy my waveform. So I'm going to be very strict and say that if the 1900 is pierced, I'm probably going to have to call this a B minus and say it's going to have to restart. But 1820.66 is really technically, that is the level where the weekly charts would break down. And I'd have to say, I don't know what the wave count is because I have to restart. So as of even this moment, right now, I still have to consider that this is a peak B and that somehow, one way or the other, we're going to try to get close to go to a C and then maybe a D. I don't know how that's going to work. And then we get a deeper correction because we could be looking at a rotational correction now, because if you look at the XLF also has made this peak B in the weekly chart. It's acting very poorly. If you look at stocks like AZO, which is the auto parts, they are not doing well at all. So we've finally got the sector rotation in sectors that were doing very well. If you look at the IBB, which is up 4.94, it's hanging in there by the skin of its teeth. It's just managing to hold in, but it hasn't broken down. It still hasn't broken out yet. I still have unrequisite leg D in the daily and the weeklies to come. So I'm going to put it together, and let me try to answer a question of your, well, first of all, give me your exact question so I can go specifically to the answer.
So if January we stay above the 9 period, but we close down for the month,
yes.
And then do you expect February could be a lower, a down candle as well, or do you expect a bounce in February then?
So your question is, if in February we close underneath this 9-period moving average of 1983, would I expect that February is going to be weak as well? Regardless
if January we stay above the 9 period.
Oh, above.
So we closed above, but we have a down candle, but we stay above.
Oh, if we stay above, that's going to be really good action. That's just going to speak to the rotational nature of this market that says, instead of getting your usual like wave 4 to the downside, an Elliott wave, and certainly a peak E, a normal peak E in my monthly charts, that would normally take you back down towards at least halfway into the candle of that would be 1906, the candle of that October beautiful candle. You'd go into the wick, and if you traded there for 2 weeks in the 1906 level, that would suggest there's a real good chance you're going to go towards the bottom of the candle. So all I can say is, if after all this, the S&P manages to hold above 1983 on the very last day of January, which would be, let me just double check here, the very last day of January. Of course, I haven't got it up. I thought I did. So the very last day, where my calendars, I got like 3, but they're all hidden away right now. All right, I can't tell you what the last day of January is. There it is. Then what we'd be looking at is outstanding action, saying a rotational correction has gone on. We've got sectors that have pulled back very sharply, but we've got leadership. Now, I don't know where the leadership would come from. I thought it would be the auto companies, the American auto companies, and so far they've pulled back pretty darn sharply on every pullback. So we're going to go to 31. That's the 30th is the last day of January, Friday the 30th. So you can see what I'm looking at here. If with all this information, with the volatility index in the 23, 22 area, if we can't break down, it's talking about strength. It's exactly the same as if you're looking at gold and you're saying, wait a minute, look at this candle, monthly candle of gold. It is beautiful. Look at the weekly candle. Look at the daily candle. And yet the dollar, normally you'd get this counterpoint. The dollar is at recovery highs. That's talking to internal strength in the gold and the gold stocks. And you've got this exact movement in the dollar that says, geez, roundabout here, you should be getting into some kind of resistance. This is your monthly trend line. You're exactly at the 92, the level of last, if I squash the chart. Yeah, you're going all the way back to, there it is. You're going back to 92.63, which was the November 2005 high. You see that we've got a whole bunch of things going on here that is speaking to rotational strength and the fact that under normal circumstances, crude oil, high-grade copper, all of this speaks to the fact that crude oil should, in fact, have been a very big positive for the market. But then when it dropped so sharply going into the 40s, that says to you, wait a minute, isn't that talking about a lack of economic recovery? So if I try to put the whole package together, I'm kind of impressed with the way the market is held. I mean, we do technical analysis, we do a little bit of fundamental, I do a little bit of fundamental analysis, but mostly it's technical. And all I can say is looking at the charts, and of course, this is Friday, the weekend, this is options expiration. We could still close down instead of being up 49. We could close down 150, and that'll be very negative. But at this particular point, I'm just kind of impressed that the market is held up as well as it's held up. And that's about the answer that I can give you. But I've given you on the S&P, I've given you very specific levels. On a one-week basis, if next Friday the S&P closes underneath 1984, 83, that's a heads up to say, hey, be careful that H formation and the up channel that you've got here as support starting to break down. Watch out for that candle of December, which had a low of 1972. So I'm going to give you the levels rather than to say, hey, we've held up very well so far. That's very positive. The VIX is soaring, and yet the market is not down. I mean, the Dow's not even down 1,000 points from its high. That's kind of impressive. I'd rather say to you, hey, Marvin, just watch these levels. You're talking about the S&P. If we break down, not intra-week, but on Friday, because you're talking about weekly charts, if the weekly chart closes under 1982, certainly under 1980, which is the monthly 9-period moving average, that's saying, watch out, we're going down now. And we're not going to just roll over for another week or two. We're actually going to go much lower. If the S&P is able to rally next week, something 2020s, that'll be good. Hope that helps you, Marvin. Thank you very much for calling. I appreciate it. Folks, have a great weekend. Check out my opening calls, my daily newsletter, and I'll be back Monday. Have a wonderful weekend.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. The Art of Timing the Trade charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Learn about good health and fitness. Living a Primal Lifestyle with Nico and Paige. Next on TFNN.
Hi, folks. We're back. Sorry about that. I saw Nico warming up for living a primal lifestyle, health signals, and for some reason, I thought that was it. Let me just quickly check. Yeah, there are a bunch of things. Dan, can you just email me and I'll give you those numbers. But I can just tell you right now, in terms of the stochastic and MACD, the numbers I use are just standard. MACD is 12.26.9, and for the slow stochastic, it's 14.331 and 20% and 80%. I hope that helps you. But if you want, just email me. We can go through it. Okay. So now let's go back to my story here. Just to finish up, to be as clear as possible. I'm really not trying to be Pollyannish. There's no way. I've already spoken about, I said in December that I was expecting a double-digit decline sometime in January, but because of the waveform, I'll have to see how the weekly charts work out. And all I was expecting was 18,104 for the Dow, and then I'd have to worry about whether the S&P went to 2093.56 to make leg C. And then I'd have to figure out, is it going to go to a D, or do I put all my weight on the Dow and just start shorting the heck out of everything, expecting a pullback? Now, let me just run this, be as clear as I can. A question of the day, and a really good question, was basically Fletch in the Den said, Basil, VIX soaring and market holding here. Is that denial in the sell-off? I always talk about that. I always talk about for my subscribers, I always show this quintile here, where you've got the Dow 120-minute chart, the VIX 120-minute chart right here. Actually, it's usually, I wanted to expand it to show those oval patterns. What a beautiful technique. I did not follow it. It hit a D. I just should have been shorting. That's the way to make that oval formation. My mistake. Sorry. I have to apologize to my subscribers. Usually we get these. I did not. So the trend trading right now at 83 is basically ignoring both the rally and the pullback. And the other day did hit 243, it hit 2.43, which gave me that intraday very sharp expansion in price, which so it's really about a 98% accuracy rate. And here's the SPY and the SH. You see these oval patterns coming together, but this is the area where you can start to get the bounce. So let me just make this clear. Yeah. This is the weekly chart. This is not the exact up channel because you went lower, but it's an up channel. If I squeeze it, you'll see that it's a verifiable up channel because it goes from way back. It really goes to the June 2013 low right there, and it hits enough troughs exactly to be able to say that was an aberration to the downside. Now, this is another thing about chart formations. Very often, I'm sorry. I'm doing three things at once. I need to just clarify with Fletch. What I said was the next 2 points up or down in the VIX index will probably determine the trend for at least a little while. And that would be a big move either up or down in the indices. So if the VIX spikes into the 25s, you bet that the markets are going to be pulling back quite sharply. And if it suddenly drops into the 19s, 18s again, it allows some room for a bounce. Now, let me just go through this again. Here's the S&P weekly chart. Normally what happens in moves like this is that you get a break to the downside. Then what you do is, especially in an up channel like this, you get a break commensurate, not necessarily exactly proportionate, but commensurate somewhat with the down move of the break of the trend line to the upside. I'm not even expecting that. All I'm expecting is modest highs, 2094, let's say, or 5, and in the S&P, and then a sharp pullback. But that's my thinking. Trading and putting on positions, that says, hey, look at every stock and every index because individually they could be doing something else. So look, here's the arch formation. So far, it's not showing any strength. You would need the S&P to break into the 2020s to show at least a modicum of strength, because if it breaks into the 1980 or lower level, not good. Hey, I'll be back. I'll be back on Monday. Check out. No, on Tuesday we got a vacation.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.